Right now, there's a psychological phenomenon called loss aversion. It's the human tendency to fear losses more than we value gains. And today, that exact instinct is driving people away from one of the biggest opportunities sitting right in front of them. Let me explain. Gold is down over $100 today. Silver has dropped more than $2.50, and most people watching that red on their screen are feeling something scientists call negativity bias. Our brains are wired to react harder to bad news than good. So instead of thinking clearly, people panic, they freeze, they walk away. But here's the thing, that's exactly when the smart money moves in. First, what's actually happening right now? This morning, reports broke that Iran launched drone and missile strikes on oil infrastructure inside the UAE, specifically hitting a facility in Fujairah. Within hours, Brent crude oil shot up nearly 6%, crossing $119 a barrel. Bond yields jumped, stocks dumped, and the US dollar index surged. Now here's what most people don't realize. When the dollar strengthens, it puts direct downward pressure on gold and silver prices, not because the metals lost value, but because a stronger dollar makes them look more expensive to international buyers. It's a short-term optical illusion, not a fundamental shift. Peter Schiff said it perfectly on X today. Traders are selling gold and silver because of the war escalation, not understanding that historically these are exactly the conditions that make precious metals explode to the upside. Their ignorance is your opportunity. Now, let's talk about silver specifically, because this is where it gets serious. Analyst Rishad Hajiev recently flagged something that caught my attention. Silver has been consolidating inside a 6-month triangle formation, a technical pattern that once it breaks tends to move fast and hard. He's calling the coming breakout potentially historic. Here's his logic. In the previous 3-month run from October 27, 2025 to January 28, 2026, silver gained 170%. That alone was remarkable, but he believes the next rally could be even more aggressive, potentially producing 200% from current levels. That puts his minimum target at $240 silver by July 2026. Now, $240 silver sounds extreme, but there's actually a structural reason why July specifically matters, and it has nothing to do with price charts. This is the part most people completely miss. On January 14, 2026, a government proclamation went out directing the Secretary and U.S. Trade Representative to evaluate price floors for critical minerals, including trade-restricting measures. The deadline for that review, July 13, 2026, exactly 180 days later. And silver, as of November 7, 2025, is officially classified as a critical mineral by the U.S. government. That means within months we could get formal government guidance on a silver price floor. MBA economics who flagged this thesis put it this way. The idea didn't come from analysts or speculators. It came from the government itself. He simply connected the dots. Now here's his deeper theory, and this is where it gets really interesting. He believes a price floor won't just support silver prices, it could serve as political cover for the COMEX to declare force majeure, essentially a legal escape hatch that lets them avoid admitting they ran out of physical silver, while simultaneously bailing out naked short sellers through cash settlement. If that happens, the people who are holding physical silver before that date are in a completely different position than everyone else. And here's the inventory data that backs this up. The 16-month COMEX silver accumulation has been completely wiped out.
Inventory just hit its lowest point since December 2024, erasing every ounce that came into American vaults during the tariff panic of 2025. All of it gone. Some people assume it just shipped back to China. And yes, some silver is moving east, but here's the reality. London and New York City alone account for 96.7% of global silver inventory. The physical metal is still concentrated in Western vaults. What's disappearing isn't moving. It's being consumed by industrial demand, by stackers, by the market itself. Supply is quietly shrinking. The deadline is approaching, and prices are down today. That combination is not a warning sign, it's a setup. Now let's zoom out for a second, because there's a macro layer that makes all of this even more urgent. The Wall Street Journal reported this week that U.S. national debt has officially crossed 100% of GDP. Let that sink in. The total debt the United States carries is now larger than the entire economic output of the country. The last time we were anywhere near this level was World War II, and the chart isn't flattening, it's accelerating. The trajectory points directly toward breaking that post-war record. What does the government do when debt spirals out of control? The same thing it's always done. It prints. More money in circulation means more inflation. More inflation means the purchasing power of every dollar you hold quietly decays. Gold and silver don't decay. That's the whole point. So, here's where I land on all of this. There's another psychological term worth knowing: present bias. It's our tendency to overweight what's happening right now and underweight what's coming. Most people see today's price drop and react to the present. The disciplined investor sees the trajectory and positions for the future. July 13th is roughly 60 days away. The silver price floor review lands, COMEX inventory is depleted, a potential historic breakout pattern is forming, and U.S. debt is setting up for more money printing, which is structurally bullish for every hard asset. The metals are cheaper today than they were yesterday. That's not a problem. That's the entry. I'm not here to tell you what to do with your money, but I know where I'm adding to my stack, and I know which direction I think this goes before summer is out. Drop your thoughts in the comments. I want to know where you stand on silver right now.